Welcome back, awesome people. In today's episode of the learning series, I will be going over what happens when and if you swing trade, day trade, or trade speculative stocks in your tax-free registered accounts, specifically the tax-free savings account, the TFSA. Canadians have the perfect tool to hit long-term financial goals, the tax-free savings account. The beauty of the TFSA is that you can grow your money tax-free, and any withdrawals won't incur any taxes as well. However, there are errors that you can commit that could land you in trouble, so you should avoid locking horns with the tax agency. Many Canadians think that their tax-free savings account is off limits by the CRA, or the Canada Revenue Agency, as long as they don't go over their annual contribution limit. Well, unfortunately, that is not all correct. The TFSA was meant to help everyday Canadians build wealth that's free from effects of taxation on dividends and capital gains. And it was not intended to be a free pass for those who make a living by trading stocks frequently. Income versus capital is one of the most complex issues in tax law. In general, each time you sell a stock, the gain on that stock can be considered a capital gain, of which only 50% is taxable. But if it is considered an income gain, then 100% is taxable. So make sure you speak with your financial professional to determine if your gains are capital or income. If you use your TFSA to make extra income through trading, you could still have your gains taxed if the government deems that you've been conducting a trading business, or if you've been simply making a killing off of penny stocks, NJ stocks, speculative stocks, leveraged ETFs, or any other type of stocks in your spare time. So if you trade a considerable amount of speculative stocks that could have the capacity of making you wealthy, it may be in your best interest to keep such activities outside your TFSA. Simply put, excessive trading within your TFSA is a lose-lose proposition. Somewhat infrequent swing trades are fine for your TFSA, but if you're consistently trading, you may have to answer to the CRA, as they can tax your TFSA at their discretion. So if you've been making money too fast in your TFSA, you can expect a speeding ticket. Now, here are the 3 factors that could determine whether someone is deemed to be trading in their TFSA account. The first is trading frequency. If you're an active trader that buys and sells stocks inside your TFSA several dozen times a year, you could be considered a trader and not an investor. If you are using the TFSA account to channel personal income as opposed to investment income, then your TFSA will be assessed as a personal account and won't have the benefit of tax-free gains. And trading once a year or once a month won't raise suspicion, but more frequent trading might. The reason we all say might, maybe, here, and this is because there is no clear line of what frequent means. But you need to ask yourself, can the frequency of my trading trigger a flag? I personally, swing trade about 2 to 3 times a month in my TFSA. So that is on average about 25 to 30 times a year. As to me, that is not an amount that will trigger a red flag. To me. Again, that is my personal preference. Please do your own due diligence and speak to your financial advisor for more personalized information. The second is duration. How long are you holding your holdings? Now, we don't know exactly how long is considered too short or too long when it comes to holding stocks. So what concerns the CRA is if the intentions are for resale. The CRA will try to determine whether you're acquiring the stocks to resell them at a profit or holding them for long-term growth and dividend income. Also, the nature and quantity of these stocks. The tip-off for CRA could be someone buying and selling the same stocks over and over again in large amounts. And third, any and all registered accounts. Now, advisors and financial professionals tend to focus on the TFSA, but in theory, the long arm of the CRA could reach into your other registered accounts as well if they deem that you are using them for trading business. And that includes your RRSP, your retirement plan. And even your non-registered taxable accounts can be greatly taxed, where they can disallow the capital gains tax reduction. Although this can happen, I personally have never heard of it happening, where the government can disallow the capital gains tax reduction in your non-registered account. As you know, anytime the government gets worked up about collecting unpaid taxes, people tend to get nervous. Should you be worried if you took a big successful gain on a penny stock you were sitting on at a 10x gain? Highly unlikely. Those attracting the attention of the CRA are a tiny subset of investors who might not only be betting on high flyers, but also likely trading in their accounts full time. And many of them tend to be investment professionals, so they kind of know what to do. If the tax person is after you and your TFSA, it's much more likely because you contributed beyond the annual contribution limit, rather than because you're a wildly successful investor. Unless your TFSA is worth about $1 million, but I'll get to that shortly. Now, the rules on TFSAs have not been 100% clear, even up to now, and that could be fueling some of the anxiety investors are feeling. Investors generally have a lot of leeway when it comes to investing in their TFSA. But two things that will get you in trouble with the CRA are, one, are you holding appropriate stock? Now, many of us don't actually think about this because, most stocks that we are looking at are very, very well known. Well-known stocks that we can keep in our TFSA, such as common investments, including GIC, stocks, bonds, mutual funds, and ETFs. But it can get complicated if you chose a fairly little known investment or one that's not listed on an allowable stock exchange. And the Income Tax Act specifically states that for a stock to be a qualified investment for a TFSA, it generally must be listed on a widely known specified stock exchange. Second thing, is your TFSA balance close to $1 million? Over the last few years, a few TFSAs have grown to over $1 million or more, and this has the CRA asking questions. The CRA is focusing its attention on accounts where people have accumulated large sums of money, close to $1 million in their TFSA. And at this point, the CRA will do a statistical analysis and try to determine what returns a very good investor would get. They may have been able to turn $52,000 of contribution room into $200,000, but at $1 million or more, something out of the norm is happening. The result? A red flag goes up for the CRA. But what if you're just a good investor? Well, think about it this way. Even if you put money in Google and Amazon shares several years ago, two stocks that have had spectacular market returns over the years, your TFSA still would not be worth $1 million. And the only way you could have done that is through trading, because you're not doing it through investing. So simply put, many of us average investors should not worry about buying a penny or speculative stock and holding long or infrequently swing trading in our registered accounts, because many of my viewers are nowhere close to $1 million in their TFSA, including myself. And a bonus factor that will get you in trouble is over contributing to your TFSA. Now, monitoring your over contributions to the TFSA is an ongoing administrative duty for the CRA, so it is nothing new, as I personally have over contributed many times, and they just sent me a letter simply stating to remove the excess amount that I've over contributed by a certain period of time before the excess starts accruing a 1% monthly tax. They do give you a warning letter, and that is about it. Even for the 2019 tax year, only about 25,000 Canadians, or about 0.18% of the 15 million TFSA holders, were issued an automated notice of assessment as a result of excess contribution. So over contributing happens to the best of us. Just remove the excess contributed and you are done. So not much to worry about this factor. Now to summarize today's episode. Firstly, don't over contribute. Contact the CRA through phone or online services and find out how much contribution room you have and manage your finances. It's 2021. it's about time. Frequency. Don't buy and sell constantly to a point where you are making 50 plus trades in your registered account, because it will surely trigger a red flag. And duration. How long you hold is a personal decision. I get that, as it is based on market fluctuations, and it is your money technically. But if you are holding for days and weeks with a high frequency of trading on top of that, it will surely trigger some red flags. So be careful how much and how long you're trading for. And don't forget, if you want free money to trade with and $0 commission fees that won't eat into your profits, sign up with my Wealthsimple link down in the description box below, where you will get $25 of free real money to trade with. And if you don't like Wealthsimple Trade, maybe Questrade is more your style, you can also sign up with my Questrade QPASS key code for free money as well. You will get $25 once you sign up with my QPASS key code and start trading in minutes. Both links are in the description box below. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to wealth and the key to financial success. So subscribe, like, and share to help out the channel, and so you will get notified of when I go on YouTube Live or of my recent posts, as I will be posting my penny stocks, REITs, dividend, and speculative stocks from my portfolio and investments I am currently buying and selling. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride 2021 together on a journey of health, love, and success. So until the next video, stay ranting.